What's up, apes? Welcome back to the Daily Peels podcast / video stream of the day. My name is David, and we are hyped the fuck up today on this beautiful Wednesday, July 10th, 2024. It is 7:22 p.m., and the S&P 500 is once again at all-time highs. What's not to be excited about? 6 days in a row of all-time highs. We all know that gains in the stock market is the entire purpose of life. If you're not creating shareholder value, what the hell are you out here doing? Why are you in the United States? Please leave and make some room for somebody who is dedicated to that glorious quest of shareholder value creation. Speaking of value creation, the WSO Alpha portfolio was up a solid 60 basis points for the session here today. Relatively good day, but not compared to the S&P 500 or the NASDAQ. The NASDAQ was up about 118 basis points, whereas the S&P was up 102 basis points. So they didn't necessarily double us, but they certainly did beat us by quite a bit. It was a good day for big tech, not necessarily a good day for our barbell strategy. Make sure to go ahead and sign up for the Alpha portfolio if you want to see what I mean by the barbell strategy. You can see exactly the trades that we're putting to work out there. We're thinking about making some rebalances going forward these days, so you definitely won't want to miss those trades that we place and the research that comes along with it. Make sure to go ahead and sign up. Okay, let's go ahead and move into some of the banana bits for the session. Now, one of the most important things coming out tomorrow is going to be the CPI report. Obviously, the CPI has its problems, but it's kind of the biggest consumer inflation reading out there. And when I say that, I mean it's the one that people, citizens, civilians, non-financial civilians actually pay attention to. 𝗟𝗡𝗅 could give less of a fuck about the CPI because fortunately he seems to be aware of the problems with owner's equivalent rent being 1/3 of the entire index, but nonetheless it is going to be dropping tomorrow, so we'll be writing about it. But go ahead and check out that primer if you're awake early enough, which I assume is probably about 3 to 5% of you out there, but nonetheless, got to give it that shout out. Finally, Alphabet is ghosting HubSpot, completely ghosting, much like girls used to do to me on Hinge or pretty much anywhere that I've ever been in my entire life. But Alphabet is doing that to HubSpot now, and the stock is getting brutalized for it. Alphabet is basically ditching HubSpot as an acquisition target. They're saying we're no longer interested going forward, and HubSpot is crying about it just like I do every night when my head hits the pillow. Okay, 𝗟𝗡𝗅's speech. He gave another speech here today on Capitol Hill. He was back there rizzing up senators, congresswomen from Elizabeth Warren to 𝗟𝗔𝗡𝗪 𝗪𝗀𝗪 and the S&P 500 absolutely loved it, like we said, closing at all-time highs. He basically said the exact same thing he said yesterday, just that they're going to be cutting interest rates. They just don't know when or by how much, but that is the direction that stocks are going in. Finally, HBO's coming documentary. HBO, once again, is one of the only streaming services that you need. HBO, Netflix, and expensive YouTube TV. You'll be completely covered with all that stuff as I try to advise to my parents, but they're very dedicated to the game of paying a $300 cable bill. To each their own. Why not? Nonetheless, HBO is going to be coming out with a documentary on a couple of space, I don't want to call them startups, but they are young companies, certainly, extremely young. We're not talking about SpaceX, Blue Origin, Virgin fucking money loser, whatever the fuck Richard Branson's Virgin Space is called, or whatever the hell. Who even cares at this point? But HBO is going to be focused on 2 other publicly traded companies and the ongoing space race occurring here in the United States. So you're definitely going to want to see that, especially because it might pump space stocks. It's kind of one of those things that, like, when the documentary is released, people start to watch them. They pay attention to these tickers. So it could be a nice pump and dump triggered by HBO. But if only they could do that to their own stock price. I mean, I'm sure they would absolutely love that. But nonetheless, let's go ahead and move on into our major story of the day. So for our macro monkey today, we are talking about moving up and to the right. Now, we already know the S&P 500 is doing that, but did you know that the housing market is doing that as well? We all know over the past couple of years, the housing market has been the bane of the existence for everybody under the age of 35 here in the United States. It's basically the millennial and Gen Z equivalent of the Vietnam War, if you ask me. Only difference is, while our cool, sick-ass, actually valuable human beings in terms of our grandmothers and grandfathers have stories like getting shot down over Saigon and got to get out of enemy territory, we're going to have stories about getting offers shot down over Millbury, Massachusetts, and fucking getting it out of that enemy territory by eventually getting a buyer or a seller to be dumb enough to accept your offer. Nonetheless, that is the war that millennials and Gen Zers have been fighting in the housing market recently. And, it's finally starting to turn back in our direction. The troops are being called home because there's finally homes on the market for Gen Zers and for millennials to be moving into. Let's go ahead and check out the numbers because conditions are getting a lot better than they have been in past years. And we can see that most notably by this chart right here. So what we're looking at here is active listings in the United States. These are houses currently available on the market with sellers begging for somebody to give them hundreds of thousands of dollars in order to move out. It hit a new high since June of 2020. Oh, I didn't mean to move on to the next chart just yet. But it did hit a new high since June of 2020 in May. So we are very excited to see that. Keep in mind, it takes quite a while for any data to come out in the housing market. Just talk to S&P Case-Shiller about how quickly they track prices. It's similar for listings and selling activity because it's like a month-long process and everything. But nonetheless, seeing that back at all-time highs is extremely promising for home buyers that want to keep both of their kidneys and still be able to afford a home. Now, the reason that it's for this uptick is because both new housing supply and existing home supply are both once again moving in the right direction, that up and to the right. What we're seeing in this chart is a pretty cool metric. So this is talking about the month's supply of houses on the market right now. When I say month supply, that effectively just means, if every single house available on the market right now was to be sold at the current pace of monthly sales that occur in the United States, how many months would it take for the market to run dry, for there to be no houses left? And that's basically what we're measuring when we talk about month supply. So for new homes, we're at 9.7, and for existing homes, we are at 3.7. So these are both all-time, or not all-time highs, but highs that we've seen for the first time in the past couple of years, especially since about June of 2022 for new homes and since about October of 2022 for existing homes is what it looks like. So obviously, once again, listings, supply of housing is moving in the right direction. Economic students out there know that when supply is increasing, that should bring pricing pressures down. We'll see if that actually plays through because it's going to be an interesting conversation going forward, because typically what happens when interest rates moves lower is that the principal asset, the value of the principal asset increases. So in the case of housing, interest rates moving lower, but supply increasing, both pull in opposite directions because increasing supply is going to pull prices down. Falling rates is going to move prices higher. We'll see which one has more magnitude going forward. My guess is that it's going to basically normalize and be relatively equal and not get that much better. But it's nice to see that homeowners are starting to adjust to the higher mortgage rate environment. If we scroll over to our next chart, what we're seeing is the story of mortgage rates. This really encapsulates the housing market and why it has felt like fighting in the Vietnam War in the past couple of years. In this red line, we can see the current 30-year mortgage rate in the United States. Pretty much every mortgage, 90% of them as of right now, are done at conventional 30-year fixed mortgage rates. Meanwhile, what we see in this yellow chart right here are total loans outstanding, or the mortgage rate on existing loans. And over 2/3 of existing mortgages in the United States are at a sub 4% interest rate. You would have to move mountains to get me out of a house if I had a 3.5% interest rate. The home that I just purchased, we have a 7% rate, and I'm ready to shoot myself in the face about it. But hopefully, fingers crossed, it's true that you can always really refinance. We're going to be putting that to the test, and we will definitely keep you guys updated with that multi-year process going forward. But nonetheless, home owners, home sellers are adjusting to the higher rate environment, starting to say, listen, we just got to get the fuck out of here. And the appreciation of home prices could actually be contributing to this, because they might be saying, you know what, we are going to have to take a higher rate, but our house has grown $150,000 in value in the past 3 years alone. Might as well cash in while we can. And home builders are starting to say the same thing with new home supply increasing. They're saying, okay, maybe we're being kind of pussies by still not building houses because we're traumatized from the global financial crisis. But nonetheless, at the end of the day, we are just happy to see houses moving back in the right direction. Obviously, the market had to wait until I actually had an accepted offer on my house to start to heal a little bit whatsoever. So you guys can all feel free to thank me for that. It's Murphy's Law. Once again, what can I say? All right, let's go ahead and move into some of the big stock movers for the day. Fair warning, every single stock we talk about and its movement is entirely driven by artificial intelligence. I think we've officially reached the singularity here at the Daily Peel because AI has completely taken over tomorrow's newsletter. So, first and foremost, we have SoundHound AI. They were the AI king of the day on Wednesday, up 22.5% because they actually released a product. I know, it's unbelievable. It's incredible to hear that an AI company isn't just saying the word AI and getting billions of dollars thrown at them. No, SoundHound actually created something, and it sounds pretty fucking cool, but I won't be able to get it because I don't live in Europe and I don't drive European cars because believe it or not, I don't hate myself that much to stoop to that level. But basically what's going on here is SoundHound AI and their partnership with Stellantis has finally come into fruition. SoundHound just released its ChatGPT integrated voice assistant in 3 car makers across 11 European markets. So I'm going to butcher these names, but it's Peugeot, Opel, and Vauxhall, whatever the fuck those things are. Apparently they're car makers in Europe, but I find that hard to believe. They now allow hands-free control of vehicle infotainment systems. So basically you could say something like, direct me to XYZ, turn the air conditioning down, actually, I don't know if they have air conditioning in Europe. Roll the windows down, maybe, is what you could say to it, turn the volume up. You can basically control everything in the infotainment system with just your voice. And that's pretty fucking sick, if you ask me. But nonetheless, it's definitely not sick enough to suffer with a European-made car. Unless it's a Volkswagen or a BMW. Those are pretty sick. Germany is accepted from this conversation, by the way. But nonetheless, they have plans to enter about 6 more European markets over the next month or so. By the end of July, they plan to be in 17 total markets. And the stock market is absolutely loving it. Once again, sending the stock up 22.5%. Probably even more so when this comes to a real economy in the United States. Moving on down below into AMD. So, I'm absolutely amazed to find this out, but apparently there are tech companies that do exist in Europe, at least for now. They definitely won't exist for long, especially if AMD is allowed to keep doing this, because AMD, the semiconductor maker that's essentially played second fiddle or has been NVIDIA's son over the past year and a half, has finally decided to start closing its software gap with AI kingpin NVIDIA. So AMD purchased a Finnish startup called Silo AI. Silo is once again, a Finnish-based company that makes end-to-end AI systems for things like smart devices, autonomous vehicles, smart homes, Industry 4.0, whatever the fuck that means. And AMD has now snapped them up for $665 million in an all-cash deal, while acquiring at the same time 300 very technical employees. So it's kind of an acqui-hire at $665 million. And the market absolutely loved it because it seems like they're getting that additional talent for very, very cheap. And they're starting to close that software gap with NVIDIA. The stock was up 3.9% for the day. Okay. Moving on down into the companies getting absolutely bullied by AI, we have Legal Zoom first and foremost down 25.4%. Basically everything that could go wrong with the company did for Legal Zoom yesterday. First and foremost, their CEO said, I'm getting the fuck out of here. He saw the fire on the ship and decided to just hop on overboard instead of going down with the ship like a real captain would do. But quite honestly, I can't blame the guy because the company at the same time announced that they would be cutting 2024 sales guidance at the midpoint by about 4.2% and cutting free cash flow guidance at the midpoint by 11.2%. That's very stinky, things that you do not want to see your company doing. So obviously it's the market's assessment of the future free cash flows for all eternity of LegalZoom fell by a quarter on the session. Very ugly day. It's probably once again just ChatGPT coming in and consuming all that market share. Like ChatGPT is really great at helping students cheat and decreasing their reliance on Chegg. This ChatGPT, you can say to it like act like a lawyer and write some XYZ in a legal document style way. I don't know if it's necessarily as good as LegalZoom, but it probably gets you 90% of the way there at 5% of the cost. So, I don't blame a lot of companies for moving that direction. Finally, we have Intuit, not necessarily getting bullied by AI, but bullying other people using AI. Either way, the stock was down 2.6% for the session. Now, a year ago, the stock would have hit all-time highs on this news because effectively all Intuit is doing is firing 1,800 people. They are completely ending the livelihoods of 1,800 people. And they are doing it in order to invest in artificial intelligence to replace those people's jobs. So they haven't necessarily created the AI systems that are needed to replace those functional employees, but they need to create the cap space to be able to invest in artificial intelligence and start to replace those jobs for real. So the AI job replacement is quickly getting underway, even though the systems might not be there just yet. Companies like Intuit are ultimately deciding it's going to be more worthwhile to invest in this stuff than invest in our human capital. So AI job replacement, it is once again here. Okay, let's go ahead and move into our thought banana for the day. We are talking about a health tech a checkup on health tech, if you will. We're doing our own physical examination of the health tech industry, and specifically one product. And I'll give you a hint as to what it is. It looks a little bit like this. I'm sorry to disappoint everybody. I am not getting down on one knee and proposing for you all to marry me just yet, at the very least, with these rings right here. What I am doing is showcasing the Galaxy Ring, Samsung's newest product that they just released at their event. I think it's called like Unpacked or something like that. But either way, Samsung had their annual event. It's kind of like the Worldwide Developers Conference, but for Apple's little brother being Samsung, of course. And so this was kind of their Apple killer product of the day. So the Galaxy Ring, what does this thing do? Well, basically, it is a health monitor. It tracks things like your sleep, your heart rate, exercise, and the menstrual cycle for all of you women apes out there. So it does provide some valuable information. The price point starts at about $399. There's no monthly subscription for it. It's basically a ring that you slip on your finger, and it's going to track all of that stuff. Going forward, management has indicated that they want to be able to kind of integrate it with your overall health systems and other apps that you have, and kind of be able to, you know, do more readings and connect more so and give you a more holistic sense of your overall health. But if you're a hypochondriac, this is a great day for you, because now you have even more reason to freak out, because what this thing is going to do is basically give you a heads up and say like, hey, your heart rate is unusually low, or your heart rate is unusually high. And, you know, I mean, obviously, if I eat an entire bowl of sugar for breakfast every morning, my heart rate is going to spike a little bit. And that thing is going to make me think that I'm having a heart attack, and I will drive to the emergency room immediately. So I'm not going to be purchasing one of these things, but I certainly do understand why other people will. And Samsung understands exactly why they had to start selling this shit. Basically, it's because of this chart right here. So what we're looking at is the secular decline in the smartphone industry, especially from Samsung. We talk about peak Apple all the time, but nobody ever talks about peak Samsung, even though Samsung is Apple's only like real global competitor. And I don't even know if you can say that, you know, for the businesses holistically, but at least for the phone market, Samsung is certainly the one of the only key players that's not named Huawei or some other Chinese company that doesn't sell their phones anywhere else in the world. So we're talking about exactly what's going on here and how Samsung is trying to fix it. So if you're listening on the podcast, what we're seeing right now is that Samsung's peak smartphone sales reached in about Q1 of 2013, if you can believe it, at 88.5 million units shipped during that quarter. Now it has been in secular decline since that period to about 60 million in the first quarter of 2024. Nobody's buying the Galaxy S, whatever the fucks, or the fucking, you know, Supremo 69,000, whatever phone Samsung actually makes, because I personally don't know many people that have Android phones. I did used to have an Android phone, believe it or not, before I developed a brain and got an iPhone. But nonetheless, this is the secular decline in the smartphone market. And so these phone makers have finally kind of decided like, hey, we should probably stop just losing revenue and start to actually create more products that people are going to like. Apple has used one strategy. It's basically relying very much on its services business, whereas Samsung hasn't leaned as heavily into services, but they do have a lot more hardware. Like they have kind of a broader suite of hardware products that they sell, and the Ring product is just adding to that broader suite. So it makes sense within their business strategy. We'll see where health tech goes from here, because a ring on your finger that tells you how long you slept, yeah, it's pretty cool, but like, who the fuck cares? Like, it's more about where this is going to be heading that got the market excited yesterday. That about does it for us here today, apes. We're going to go ahead and call it with that one. But before we let you go, of course, we're going to finish up with our quote of the day. So if I could find my mouse and be able to scroll down on this thing, our quote of the day comes from Mr. 𝗪𝗏, who's the CEO of Prudential Financial. He said this at some McKinsey event, apparently. I don't know why anybody would ever go to a McKinsey event. But nonetheless, at one, he said, companies don't exist for 150 years without reinventing themselves. Samsung has been around for like 60 years now? I think it was founded in like the 60s, or maybe more so like the 80s. So either way, somewhere about 40 to 60 years, they are reinventing their revenue mix, I guess, and moving more into the health tech space, less reliant on smartphones. And that about does it for us today, guys. Happy investing to you all. Hope your portfolio is blessed tomorrow with many, many gains, and hopefully the WSO Alpha portfolio is right alongside you with that. Nonetheless, like I said, that about does it for the session here today. Happy investing, happy trading, and we'll see you guys tomorrow. Bye now.